Hey guys, what's up? It's Stock Sniper Trading. I'm your boy Ronnie. My partner's Dave. Guys, we're gonna do more of these videos on YouTube for you guys. We're gonna do shorts. We're gonna do trade recaps. We're gonna do a lot of things coming forward. So guys, make sure you hit that like button, subscribe to the channel so you guys don't miss out. We live stream daily. So guys, what I want to do is on Friday, I want to break down NASDAQ 100. This was a trade that we took and we were accumulating a little bit of volume on the demand where we took some 5-lot trades and we took about 12 scalps for about just over $5,000 in the midday afternoon. So I want to break it down, guys. I want to make sure that you guys understand that Wall Street, we should always, when we're doing some midday, we're doing power hour. Power hour, guys, is the last hour of the New York SE equities market. It's from 3 p.m. to 4 p.m. Eastern. So that's when there's a lot of volatility in the market that's leading into the market close and after hours developing for the Tokyo channel. So what we like to do as scalpers, after New York has made its volatile move, mid-afternoon is a nice time where volume and volatility starts to settle down before it's making either a midday correction or a midday continuation on the institutional move that was created in New York. So let's just start over here where we had on Friday, guys, this was NASDAQ at 8:30. There was CPI news. So that's why the market dropped. This was a big institutional push to the downside. We created a big imbalance in the market. And these little pullbacks were dead cat bounces where there was some buyers coming in the market, but this was such heavy supply coming from a higher time frame. This was like a daily, weekly supply breaking down. So if you're trading on low time frames, 1 minute, 5 minute, 15 minute, 30-minute candles, you have to understand that this was been developing on a higher time frame. So that's why at Stock Sniper Trading, we conduct a top-down analysis to kind of predict this move and help get us ready for the structural breaks in the market so that we can take advantage of the imbalance in the market and we can grab those scalps with that volatility. So here it was the big move at 8:30. Then right over here we have 9:30. So this is Wall Street open. Wall Street comes with some volatility and it's kind of like the institutional move for the first 15-30 minutes from 9:45 till about 10 a.m. where the market makers are trying to grab liquidity. That's what it is. This is trading liquidity, scalping these markets, trading the markets. It's an auction. It's bids and asks and volume coming in, liquidity, supply and demand. So it's a battle between the buyers and the sellers. And what they try to do is try to trap liquidity so that they can move it and push it forward, either in a continuation or in a reversal pattern. So down here, we had the push down, continuing to push down. All of these little bounces, they were creating supply. Like there was more supply coming in the market. So every time we bounced, we had supply come into the market on a higher time frame. Then 9:45, we start to get this bearish run. Once we broke this little short area of demand, it just developed right there. It was only a couple quick bounces to hold the book right there until they can continue to push it down. So that's what you're going to kind of see. You're going to start to see that there is dip buyers. There's traders that are coming in believing that this is the dip buy, and then they get sucked in and then they get squeezed, and then they buy again and they get squeezed, and they think this is the bottom and then they get squeezed because this is high time frame supply. This is not short-term supply. This is coming from a higher time frame. So you have to establish zones when you're trading. Try to identify supply and demand zones when you're trading. And now I'm going to lead into the institutional move was trending down. It was a big sell-off in the market on Friday, and it continued to come down. We pulled back into this supply zone right over here. So you can see going from 10 a.m. all the way to about 11 a.m., buyers continued to push into this supply, but there was a lot of supply. So they continued to push it down, push it down. We're creating lower lows and lower highs in the market. Therefore, it's trending down. And now I'm going to play it where we could possibly see coming into noon and leading into the afternoon, Friday afternoon, how maybe we're going to start to develop maybe a base on the bottom where good demand is going to start to come into the market, and maybe we're going to have a little bit of a correction or a little bit of a retracement. So when you start to see a lot of sideways action like this, red, green, we're starting to see that buyers are being met with sellers, but we have more buying volume coming into the market. So you can see it's kind of a wedge pattern now. So this was the higher time frame trend coming down from CPI, coming all the way down. And then you see we start to wedge a little bit, where we could possibly get a nice little wedge break here and then build a demand base off of this. And maybe we could break this supply zone later in the afternoon. That's our targeted area. These dollar signs I have up here is to signify liquidity, okay? If you guys don't understand what liquidity is, there is liquidity waiting in the market right over there. This used to be a demand area. It turned to supply now, and we have liquidity sitting in the market. So we're looking to fill the imbalance, and that's where, as scalpers, we're looking to get into the market. We maybe identify our zones, how big of a zone that is. That's a 50-point zone, 50 pips on NASDAQ. And then when you decide for your type of account, your contract size, your lot sizes, don't over leverage your accounts, guys, because if you're over leveraging your accounts, remember, you're trading against big players in the market, okay? And big players have bigger capital than you. So if you can't trade with that type of leverage for your account, then that's where we start to get squeezed out of position, and we're forced to close trades because we get liquidated out by the bigger players. So what we see now developing here, what we were looking at when we started to do our charting for our midday afternoon scalp, we started to see a area of demand starting to develop down here at this area of 11,800. You can see now we're ranging, okay? It's coming up to supply in the market, pushing down, coming now, developing this demand, and now we're starting to break out of here. So I like to use also RSI indicator as well, a relative strength index. The reason why I like to use it is because I like to see when we're going into maybe some oversold conditions and there could be some bullish divergence on it, and that will give me some extra confluence that I can with high probability, I know that there is some demand and buyers developing, while the big players, the sellers, are pushing down the market to grab that liquidity. So if I add now RSI on my chart, this is this indicator over here. So most of you guys are familiar with this. It's a sub chart indicator. RSI, relative strength index. This is a momentum strength indicator. It oscillates between 0 and 100. I like to place a psychological 50 line right in the middle to tell me if the momentum is breaking bullish above there into a psychological bullish territory, or if we're going to stay below 50 and stay in the psychological bearish territory. We could possibly push up to the 50 and then get rejected there, and then that's where that resting supply zone is waiting right up there at 11,900 in the market. But what I can see now is, as we were pushing down in this wedge formation, lower lows, lower highs, pushing down, our strength is actually starting to increase a little bit, okay? So that is a little bit of bullish divergence. Ask yourself, if the price and volume is dropping, making lower lows, but the strength is increasing, then we have divergence in the market. And this could be an institutional push down to pick up that last bit of liquidity that's down there before they start to buy the bottom, and then they start to push the market up. So what we like to do is we also like to develop and identify resistance areas right here. This is a resistance area, and above resistance, we have a little bit of short-term supply up here. So what we're trying to do is break through this area and cause an imbalance in the market and retest this block for demand, and then we could possibly push up to our next zone. So we identified some bullish divergence. We have buyers now coming in. So now we could possibly be getting rejected at this supply, or we could close above and move to the next zone. If it comes back down, what we're looking for is we're looking for these buyers who bought in to hold this positional block right here. We want to see them additional ask coming into the market, more bids coming in, more bids, building up the tape. So that's what we want to see so that we can break out of here. And traditionally we have a double bottom pattern, which is it comes down, back up, and we're looking for a double bottom to see that support coming in of that demand, and then possibly we might have enough momentum to break out of this area and retest, and then we can build our way up to the next zone. Okay, so that's what the patterns. When you're a price action trader, you use the historical data of the candlesticks on a higher time frame when you're doing top-down analysis to understand where zones were developed in the past and where the auction took place, because this is an auction, it's a marketplace, and we're trading liquidity between supply and demand. So we like to know, where were the players, where did they come in, where was most of positions being liquidated at. So this is what we need to figure out in the markets when you take your trading to the next level, to understand more liquidity trading and reading the tape. Okay, so now I can start to see what's going on in the market. Okay, so let me just freeze it right there. See the supply zone. If you have the supply coming across and the demand zone going across, now it's almost 1:30 p.m. in the afternoon. We're going into 2 p.m. 2 p.m. is a large candle that comes into the market. It's a 4-hour hourly candle that's coming into the market. There could be 4-hour higher time frame volatility coming into the market. So we got to start to see where this accumulation was taking place and what is the next bigger move. So we can see we penetrated into the supply, got rejected. We penetrated into the supply, got rejected, penetrated into the supply, got rejected, and then the supply took us back down. But we're starting to build a little bit of a higher low base right here. So it's building this higher low base, and you have now resting demand coming into the market, holding this position on a higher low. And then you get this big bullish candle. So we're still looking to break volume above this supply zone so that we can cause an imbalance in the market and push up to our next higher time frame supply zone. But this could also come back down, rejected, and we could test here. And if the market really, if a big player comes in this supply and pushes down, he's probably going to protect his order right here and really go for this break of demand, and so he can get paid and cause the imbalance short sell in the market coming down for possible power hour, where the market could really take a nosedive on Friday afternoon, unless they're going to protect this area going into the close of the weekend so that they can set up their Sunday institutional move when markets gap up or gap down on Sunday. Okay, so they're just trying to absorb as much liquidity as they can before market closes. And we started to accumulate at this demand area. Okay, we started to see what was going on, and when it came back over into this area, added some more positions at these demand areas. So these are static zones that are respected throughout the day, and the only thing that's variable is the volume moving up or down, and that will cause these to cause an imbalance in the books, and supply turns to demand, demand turns to supply. So if I just keep running it a little bit more, there we go. So this is what we're looking for leading into 2 p.m. Okay, right over there. So it came, these guys closed above, the demand came through, but next candle was red, bearish engulfing, came all the way back down, but it was met with this higher low wick, and we continued having demand come in the market, where they built a new base of demand right here, and it was followed by a nice ignited bullish engulfing candle that closed above the supply zone. Here's your retest candle. It opened as a bullish candle, pushed up, but now it got pushed all the way down to right here in the zone of previous supply that's turned to demand now. So we have now the demand zone. This is your retest candle. This is the impulse candle breaking out, closing with volume above. Here's your retest candle. Some traders snipers enter in on the wick of the candle. Other traders can enter on the break of the previous close, and more conservative traders are entering on the break of the high and stop loss below a zone and continue to move up into the next supply. And you can see that move right there. If you take the retest candle, stop loss maybe right below there, 50% of the candle, and what you're aiming for is your supply target and right there it's almost a 1 to 2 on your money. But then the extension on the next candle, it broke out, it pierced through this supply, and look at where we came to. We came to NYSE Wall Street open. This is where they gapped the market down. Over here they gapped it down. So this is like the supply, bigger supply, the liquidity from New York. You can see it, how it was developed. There's those money bags right there, and it walked right into those money bags, and it got liquidated because there was so much higher time frame supply in the market, and they pushed it down. So that's why you have to secure profit when you're moving into supply demand zones, and you can that way you're not liquidated out of your position, then it comes back down and you didn't secure any pips. Because that move right there, it is a nice move for about 60 pips. Okay, so you need to secure up there as much as you can. So that was basically those buys that we started to accumulate and take up with the market. So this was a midday correction leading into power hour. And then now you have the power hour move at the end of the day. And if you were following everything at the end of the day, you could see that we were trending up from this demand area right there. We came up into the supply again, but now we have bearish divergence leading into power hour, guys. So we're making higher highs right up there. That was a big impulse move where it grabbed all the liquidity, stop loss hunt, hit the pending orders. They liquidated up there, okay? There's money sitting up there. If the market players know that there's money sitting up here and power hour, they're gonna short the market down, why would they not wanna come up and pick that last bit of liquidity there? So there's the liquidation at the supply area, the momentum push down, break the trend line, close below, retest, market dump, sell off. Okay, and most of our snipers got these plays. So guys, I hope you guys enjoy these educational videos that we're going to start to drop. But please guys, like and subscribe. Leave a comment below. Please leave a comment below on what things that you would like us to present to you. What type of webinars? What are things that you're struggling with as traders? Would you like to learn more about price action candlesticks? Would you like to learn more about market structure, support resistance areas, chart patterns? What about psychological mindset? How to develop a trading plan with proper risk and account management? Drop us a comment, and we'll look into this and we'll create these. We're going to create more of these videos. I hope you guys enjoy it. Enjoy your weekends, guys. And we'll be back Monday morning, New York live. If you'd like to join the SST community, we have a private Discord. We have a whole team, a whole sniper crew. We have live London sessions, we do live webinars, live back testing, live Q&As. We do midday scalping, power hour scalping. We have a full education tutorial section. Let me just show you real briefly right over here. Like this one. This is a good webinar to just what I explained right here. Introduction to identifying liquidity trading areas which are formed at key supply and demand areas. So we have over 50 webinars that are going like 2 hours of length every week. We do them, and we have courses and everything for you guys. So make sure to leave us a like, hit the notification bell, join us at www.stocksnipertrading.com. My name is Ron, my partner is Dave, SST. Thank you guys. Peace.